Welcome to IVoT Eye On Investing, our vehicle for discussing intelligent investing from a long-term fundamental perspective. My name is Emile Westergaard, and I am the founder of IVoT Financial Training, Inc., a company committed to providing tools and training that make financial mastery accessible to everyone. To learn more, go to IVoT.academy. Today, our market analyst Andrew Tang is traveling, so financial advisor Ed Butowsky and I will discuss the latest economic news, including which sectors he is currently highlighting to his clients. I will then lead second quarter reviews of Palantir Technologies, a high-growth AI stock, and Berkshire Hathaway, a classic value stock, from a fundamental perspective using the IVoT Forecaster, our proprietary tool for performing fundamental analysis and forecasting on public companies. Let's get started.
So what I'm seeing in the markets today and what I'm advising clients to do is to stay the course. Most of our investments are interest rate sensitive, and I do believe that interest rates in September are going to be cut. I think the focus has to be on the GDP number, which surprisingly was 3%, although I don't believe that's going to be able to hold up. Now, an interesting fact that I learned just recently is that about 14% of our GDP comes from imports. So the tariff war is really not going to have a major impact on inflation, because only 14% of our goods that we use comes from outside the United States. And then you have to go in and segment every single different tariff as to how they're going to affect the world markets, or the United States market, I should say. And I don't believe it's going to be a big deal. So I think that we're going to see a focus on the GDP number. And I do believe that we're going to see a cut after the GDP number is more recently revised. And I think it's going to be revised lower. Now, Trump recently fired the head of the BLS, which I don't think was a really good move. The BLS person just doesn't necessarily aggregate all the numbers, just interprets them and puts them out. But I do think that there needs to be a lot of attention shed on the idea of how we accumulate this very important data. And it's done by surveys, phone surveys to people if they have a job, if they are buying different things. And I think that that's a really, kind of backwards way of doing it. So I think they're going to come back with a real revision on how they collect the BLS, very similar to what they did with the Boston Commission when they started looking at inflation pressures. So what I'm telling my clients and what we're focused on are utility stocks in the short run, because I do believe that the cost to generate energy has come down quite a bit, and the dividends for utilities look really attractive. And if interest rates drop, you're going to continue to see a surge in utilities, which are up about 14% year to date. I also like business development companies and senior rate floating notes. These are the ones that are selling at discounts to their net asset value. And business development companies on a whole are averaging about 12% income. And that does not include the potential for a move higher to get rid of that gap between what the value is and what they're selling at. And there are a lot of them are selling at around 5 to 10% discount to their net asset value. And then REITs, have been sold off so tremendously. I think there's a huge value in the REIT market across the board. And I'm including in that the large industrial buildings and office buildings. I think that they're going to surprise us. And people rarely do the right thing at the right time. And I do believe that in this case, if you're selling off your REITs, you're doing the wrong thing at the wrong time. So having said that, Emile, thanks for joining us today.
That was a mouthful, but that was great, Ed. Thanks for all those views on the various sectors that you're looking at with your clients. And generally speaking, are your clients uh, interested in being aggressive these days, given the run up in the market? Are they feeling like they missed something? How is that going just in terms of your own world?
Yeah, I think they generally listen to my advice, and that is that the Mag 7, as opposed to everyone thinking that they're very expensive, they're not. When you look at them
Yeah.
on a PE basis, their profit, price earnings ratio, I believe that your PE should equal the growth rate of your company. And you take Palantir that just announced, and Palantir in the short run looks wonderful. But at the same time, you have to be cognizant of the fact that it's still a very, very high priced stock, and not just the price of it being at 170, but the valuation. Whenever we talk about prices being expensive, you don't look at the absolute price, you look at the valuation of the company. And the valuation of the company should equal the growth rate of the company. And the Magnificent
Well,
Seven.
we can get into that. I mean, IVoT has some different views on that in terms of how you calculate the value of the company, but we'll get to Palantir with the tools today in terms of just saying, well, what does it need? What needs to happen? I mean, essentially, if and we can segue into Palantir. That's no problem since you brought it up. That the cash flow value according to the IVoT forecaster, and we can look at it in a minute, is $11 a share, and they just reported a very strong cash flow growth quarter, about 100% year over year, which is great. And so the question is, what? So if it's growing, if it's worth 11 and it's trading at 175, it means that the market is expecting cash flow to basically grow by over 15 times in the future. That's what the market price is telling us, because it's worth 11 and it's trading 175, about a 15 multiple to current cash flow value. So literally they're expecting what, this quarter was, let me just pull it up here since we're talking about it now. They did 200 million in cash flow in the quarter, up from 90 million a year ago. So that's a 140% increase. In fact, I'm going to pull up the tool. Let's just, because I do want people watching this show to be learning about how at least we approach valuation, right? So $219 million, when you calc it out with their net cash of 6 billion, gets you to about a value of $27 billion or $11 a share. Now, a year ago, it was only worth $5 a share. So it doubled in value because the cash flow went from 90 million to 219 million. However, to get to 173, I mean, if we grow sales at 100% for the next 3 years, and we always figure the market can only look 3 years into the future because there's so much change going on in the world, that on this basis, if it grew at 100%, it'll be worth $69. If it grew at 200%, meaning it goes from $1 billion per quarter to $27 billion per quarter, that's basically what the market's expecting. That it's in 3 years, this thing is going to do 27 billion per quarter in revenues, up from what it is today. That's obviously a huge assumption. If they do that, you'll make money in this stock. If they don't accelerate growth, I'm going to gather that the stock is not going to do much. Eventually, people are going to kind of they're going to need to see higher growth, even what we're seeing now.
You're saying here that baseline sales would go from 1 billion to 27 billion in
Per
3 years
quarter.
per quarter. That's inconceivable.
Well, I tell you what, I needed to spend a little more time on Palantir and look at what the possibilities of that happening are. I mean, there is one other lever in the tool here. Let's just pull it up. Cost of goods sold, I don't think are going to change that much. They've been pretty flat. However, their sales and marketing could go down to 20%. Their research and development could probably go down to 10%. And their G&A could go down to 10%. Okay, well then on that basis, you would need sales to get to the current value. You'd need sales to grow at 150%. roughly. So that would mean 16 billion a quarter if profit margins expand in 3 years. That's the philosophy of IVoT, that the market is forecasting the future. That's the market's job. In this case, but the market can only see 3 years. They can't see past 3 years. So we assume that in this case, 150% growth compounded for 3 years. And that would get you to $16 billion in revenue and basically get you to where the stock is trading right now with improved profit margins. Realistic in a tech company, you could see the profit margins sitting about where they would be in 3 years.
But there's no hedge fund manager or institutional manager who's investing in Palantir today for 3 years results being like this. That's why it's just pie in the sky.
I can't speak for different investors. When I ran money on Wall Street, a lot of it was, as you were saying, momentum money. They're just looking at this as a stock that's going to keep growing and keep climbing, and it's climbing a wall. I wonder actually what the short position is right now, because that would obviously be part of what could be pushing it up. So let's just I'm going to stop share for a second. And let me just look that up here. So Palantir.
It's 2.49%. There's not a big short position at all.
No, this is not a short squeeze, and I guess intelligently shorts are scared of it. They should be. And so that's a pretty good primer on how we would approach it at IVoT using the forecaster. What you want to say is that the stock price represents the market's forecast 3 years out. And if you sit and match that market price with the tool, and we're going to see a completely different stock in a minute. So that's Palantir, which I would call it the kind of classic growth stock, in this case, AI growth stock, and it's in a hot area. And it's growing very quickly. So that's pretty cool. Again, as an investment, tread with caution, as you're saying. I mean, talking about going from 1 billion to 15 billion in 3 years, in my mind, is a stretch, but it could be. I mean, it's happened. On the other side of the coin, our other stock for today is Berkshire Hathaway. Which would be the classic value stock, right? I mean, run by the classic value team. Again,
Warren Buffett.
Warren Buffett's coming to the end of his tenure, so it's going to be the new team running it, pretty much running it these days anyway. So let's look at the kind of an opposite or a completely different example of how this tool works. Right now, having given up really all of its gains for the year, Berkshire's trading at 462.5, which is right in line with its current cash flow value. So they did 15 billion in cash flow, roughly 14.7, down from a year ago. So unlike Palantir, which is growing cash flow like crazy, these guys actually saw cash flow decline, which is generally not good. Their operating businesses made less money. Their net cash, which is their investments in the market, whatever cash they went up some, but what is that? That's about it's about 10%. So that would be their goal with their investment account. And you can see that if you actually read this, about a quarter of the value comes from their investments, and 3/4 comes from their own operating cash flow businesses. So without going into it, but you can see sales declined in the operating businesses, but cost of goods went down.
That could be because they got out of so many positions.
Well, operating earnings have to do with their core business in insurance and in the freight railroads and gas and electric, right? Those are their own businesses that they own. That's different from their investments. They are sitting on a lot of cash right now. We can go down to the bottom of the tool and see that. So if I go down to the bottom of the tool, I see that they are, yeah, here you go. Cash and cash equivalents are 360 million. Oh, but I have to actually read, I have to go to the sub tool. I should break that out, but let me see if I go to level 1 quarterlies in the details here. Sorry, I don't mean to, go nuts on this, but it's interesting. So they have 240 million in treasury bills right now. So that's a lot. 240 billion in treasury bills. So they're accepting the 4%, 5%, whatever you're getting on those treasury bills right now. And I think it's very much on the new management to obviously accelerate the growth of their operating businesses and also, find ways to invest that capital. They have not been buying back their shares as of yet. That's something that other people look for, which is, if they view their stock as cheap, then historically they've been willing to go out and buy back shares, and they have not been doing that as of yet. But again, if a year ago they were growing the operating business pretty well, it's been tough this year. They had a tough first quarter in the insurance business. If they go back to 10% growth, then you've got a $550 3-year target. And if this comes back down, I think SG&A went up, but if this comes back down to 5%, then you've got a reasonably cheap stock, not super cheap. But then if they grow the underlying cash, that probably adds another 20 or 30 bucks, gets you about a 50% return on Berkshire right now. Again, if the operating businesses rebound and start to perform better.
Well, that shows the beauty of the IVoT Forecaster, because it's a classic valuation model, and that's a classic value stock.
Yeah, and basically the fun thing, whether it be Palantir or Berkshire, is to get a group of people together with our tools. For you and your friends who are investors, take those tools and start discussing it and debating it. You're all going to have different views. You're all going to put different inputs into the tools. You're all going to come up with different sources of information and insight into the underlying business. And by the way, that was all level 1. We have level 2 and even level 3 tools where you can go much deeper into the company to make your forecasting.
So I want to thank you for watching the IVoT Eye On Investing. Please subscribe to our YouTube channel and click on the link in the description to register for early access to the platform opening soon, which includes access to our powerful IVoT Forecaster and fundamental investing training. I'll see you next week for our weekly fundamental update on the market and our stock of the week.
Thanks, Ed.